The bear is winning. Hey, finance fan, welcome back to my channel. The S&P 500 has been kind of teeter-tottering on the edge of a bear market, and now we have for the second time dropped into bear market territories. God, these things are heavy. This really is not a reason to panic. Let's actually dive into some of the data and let's get to the bottom of what to actually do about this bear market and possible recession. First of all, let's go to YCharts and take a look at what is actually happening here. So if we look at the percentages from the highs in the S&P, the Dow, the NASDAQ, and the Russell, which are the major indices. But, look, I don't really pay much attention to the Dow at all, but for the sake of this, we'll put it in here. So as you can see, we are officially in bear market territory. Correction territory in the markets is 10%, around 10%, and bear market territory, meaning the sky is falling, is 20% or more. Bitcoin's kind of already been there though. So Bitcoin is down from the highs quite significantly. Bitcoin is actually retesting a pretty major resistance turn support level around 20K. So 20K was like this big major break. I remember where I was and who I was talking to whenever Bitcoin broke out of 20K. It was just kind of one of those moments. It was this huge breakout pattern that was forming, and now we are officially retesting that major 20K zone. Okay, so we know that we're in a bear market. We know that things aren't great, but what can you actually do with this information? And how do you kind of take it and analyze it to make good investing decisions from here? Well, let's dive into what we actually know. We know that the Federal Reserve is raising interest rates. We know that inflation is not cooling off. And the fact that inflation is not declining like we expected it to do, that is definitely making the market think that we are going to see more interest rate hikes from the Federal Reserve, more aggressive interest rate hikes. Unfortunately, the Federal Reserve is in a really bad spot where they are having to hike rates, which if we go to YCharts, you can see that the top segment here is going to be the inflation rate, which has definitely been skyrocketing over the months. And then we can see that the Federal Reserve has started to raise interest rates, and they are really having to get more aggressive in order to try to combat this inflation that we're seeing. However, the problem with all of this is that the Federal Reserve actually doesn't really have a lot of control over the type of inflation that we're seeing. I mean, the Federal Reserve is raising interest rates, which is absolutely going to affect how your interest rate looks on loans. It's going to affect the housing market significantly, which it's already starting to affect the housing market. What the market is trying to figure out from here is, are we going to go into a full-blown recession or not? Are we going to have a soft landing or a hard landing, as they call it, a mild recession or a very extreme recession? And that's what the market is kind of trying to figure out. But until the Federal Reserve gives us a bit more clarity on how aggressive they plan to be with rate increases, we don't really know. So even though the Fed increasing rates isn't really going to solve all of the problems that we're having with the current inflation environment, it's definitely going to help pare back demand, but it's also going to really hurt the economy, and it's going to very likely put us into a recession of some kind. That is kind of where we're at. We're waiting today to hear from the Fed to see how aggressive they're going to be with the next few rate hikes. Something to watch here is going to be the unemployment rate. The unemployment rate is still extraordinarily low. Is this going to likely increase? Yeah, it probably is. The question is how much. We have a lot of job openings right now, but we also have a lot of people being laid off. Coinbase just came out and mentioned that they're laying off 18% of their workforce. We're seeing the same thing across many different companies. Is the labor market tight enough to where we actually could see unemployment not be as extreme as, maybe we've seen historically? So that is yet to be seen. I will be watching this very closely. I talked about in my common stock profile. If you're not following me, go to shetalksfinance.com/common stock or check the direct link below in the description. I was able to kind of elaborate a little bit more on my thoughts in terms of where the market is now, where the market could go in the future. So I wanted to kind of talk about this post specifically that I put on Common Stock. I was posting that we are actually still holding pre-pandemic gains in the indices, even though we are down in the indices, meaning the S&P 500, the NASDAQ, the Russell 2000. Even though we are down a lot in the indices, we are still above and holding pre-pandemic levels. We are actually probably about 10 to 11%, depending on exactly when you're looking at price, higher from the pre-pandemic. So we haven't given back all of those pre-pandemic gains in the indices. We have given back pre-pandemic gains in many, many individual stocks. My point here with this post was trying to say that we are actually expecting earnings growth to be higher than pre-pandemic, which I'll get into in a second. So the other point that I wanted to make with this, now, could the market continue to fall further and give back and get back to pre-pandemic levels in the S&P 500 and the NASDAQ? Yeah, absolutely. That's definitely a possibility. The market can be as extreme to the downside as it was to the upside that we saw in 2020 and 2021. That was market exuberance. We could see the exact opposite happen with extreme downside, extreme fear, extreme panic going forward. So that's definitely something to keep in mind. Fundamentally, do I think that would make any sense to get back to pre-pandemic prices on the S&P and the NASDAQ? I don't think fundamentally that would actually make sense. I'm going to talk more specifically about the S&P. I'm more in tune with the S&P earnings, S&P forecasts. What I actually wanted to point out about this is the NASDAQ is down 30% from the highs. The S&P is down around 20% from the highs, right? We're in that bear market territory. It's fascinating to me how strong the S&P 500 has actually kind of been. If you look at the fact that the NASDAQ and the S&P are basically the same amount from the pre-pandemic highs, and the NASDAQ is typically way more volatile than the S&P 500. So the S&P 500 has a lot more diversification within the index. It's got energy, it's got industrials, it's got materials, right? Which have all done really well in this high inflationary environment. And oil companies are raking in earnings, right? I just think that when you're looking at constructing a portfolio and you're looking at the S&P 500 versus the NASDAQ, this is an important thing to pay attention to. The fact that the NASDAQ has been so volatile, it's a lot less diversified, and the S&P has actually kind of been a champ. So if you're looking for something that is going to still give you great returns but help with the volatility and help with diversification, I think that the S&P has proven over and over again that it just simply is a really great vehicle for doing that. Hey, if you're a high risk taker, go all you want, go into the NASDAQ. Just know that you're going to have to deal with that volatility. I don't see, like I said in this post on Common Stock, I said, I don't see the likely scenario of the indices giving back all of the pre-pandemic gains, simply because earnings are still expected to be higher than pre-pandemic levels, even if you revise earnings down and you expect less earnings for 2022. That should have said 2022. That is a error on that part. But you get what I'm saying. So I kind of wanted to just elaborate on this a little bit more and show the strength that the S&P 500 has had against the NASDAQ, proving the more diversified it is, has actually been very helpful for the investor. And it's kind of helped lessen the blow a bit more, considering that, the S&P is still 11% above pre-pandemic highs, the same as the NASDAQ. Some interesting comments that came on this was, this was a meme. Index is holding above pre-pandemic levels, and then Homer Simpson coming in saying holding above pre-pandemic levels so far, and that's very true. We obviously don't know what's going to happen, but what I was trying to point out here is that fundamentally, I don't know if I see the indices giving back all of those gains, but obviously emotions can take over fundamentals, and we may absolutely see that type of extreme action happen in the markets. And then we had a comment here: amazing how even though energy, materials, and industrials make up a relatively small portion of the S&P 500, which is very true, that merely having a presence has now become the reason the S&P has outperformed recently. And yeah, that's the whole point here, is that even though the allocation to energy and materials and industrials, even though the allocation in the S&P is not very large, it has it just has helped the S&P so much because of the extreme conditions that we're seeing in price increases in commodities. And then he goes along to say, how long will the purple line stay above the orange line on your Y-charts? And he's referencing, this image here where the S&P 500 essentially is holding at the same gains, and it's basically giving you the same gains above pre-pandemic levels as the NASDAQ. So, and the NASDAQ's just more volatile. So the question becomes, is this a good buying opportunity? Is it time to buy, or is it time to sit on your hands and kind of wait for this to play out? Well, let's pull in some data and chat through this a little bit. So this is the Yardeni forward PE ratios for the S&P 500. Yardeni data is awesome. It's free. Google it. You can get a wealth of information. I have here basically large caps in red, mid caps in blue, small caps in green. And you can see that mid and small caps have really taken a dive. I mean, the PE ratio, the price to earnings ratio, if you don't know what that is, I highly suggest Googling it. But essentially, it's taking the earnings that are expected per share and dividing the price of the index divided by the earnings to get this PE ratio, which is essentially going to show us historically, how expensive or cheap the market has been. And these are forward PE ratios. So this is taking forward estimates and telling us based on what we expect for the market to earn going forward. This is where the market is trading in terms of value, right? In terms of valuation. So small and mid caps have been getting hammered, and to the point where they are, I would say, buying opportunities, because I mean, these are lows that rival the 2020 panic, that rival the 2008 financial crisis, which were really, really intense events, right? I mean, think about what happened in 2020. The economy, the whole entire economy shut down, like gone. Burp, sleepy time, right? 2008 financial crisis, huge crisis where people were losing homes left and right. The unemployment rate spiked. It was a very, very bad time, right? Well, we are in a bad time right now, but when you kind of compare to the prior two recessions that we've had, how bad really is it compared to those? And that's subjective, okay? I don't know if I would say that the situation we're in right now is as bad as some of those prior situations. The whole entire earth and economy shutting down, and basically, homes being foreclosed on left and right, people losing their homes, people getting way over leveraged, way over their skis in terms of debt. That the housing bubble was nuts, right? I think things are a bit different these days. We do have padded savings accounts. We do have a housing market that is still generally healthy, and we still need more supply in the real estate market, right? I think this cool off we're seeing is good for it, but generally speaking, I would say our housing market is still in a healthy state. So things are a lot different. The big kicker here is inflation going into slowing economic growth. Then we've got large caps, right? Large cap PE ratio really is kind of trading back to average. So I would say that the market is not cheap on large caps yet. We would probably need to see the market decline a little bit more to say officially that we're cheap, but we are definitely not expensive here. Obviously, if earnings fall off a cliff, then yeah, the market's going to be expensive here. That's the big kicker. That's the big issue that we have right now as investors, is we don't know what's going to happen with earnings growth. We are expecting positive earnings growth in 2022. I'll say that again. We are expecting positive earnings growth in 2022. Will it be a bang out number? I don't know. Will it be what we expected in the beginning of the year? Probably not. Okay. But we are expecting growth. So it's really difficult for me to get super, super doom and gloomy and bearish here. I do to a point, and I have the expectation that the market can continue to fall. But the market falling any further from here to me is an extraordinary buying opportunity, personally. That's just me. So I say that, you have to think about your long-term goals here. You have to think about, how much time you have to be invested in the market. Is what happens in the next year, 6 to 12 months, 18 months, is what happens in the next 2 years really going to matter in the grand scheme of 20 years from now? So that's what you have to remember, okay? I just want to point something out because I think that this is big. You've already seen that the PE ratio has come in quite significantly, very significantly from the highs, okay? Now, something else to note here is that the forward 12-month PE ratio for the S&P 500 is around 16.8. Obviously, it depends on what day you're looking at it, price, all of that, right? But according to this FactSet data, okay, when this was released on June 10th, and I believe the PE ratio is still at a similar level because we've, had that sell-off over the past few days. The PE ratio is below the 5-year average, which is okay. That's all right. That's nice, whatever. But it's also officially below the 10-year average, I think that that's huge. Now, even though we have had over the past decade very low interest rates and we're seeing interest rates rise, so we have to account for that. Yeah, maybe we see the PE ratio come in a little bit more. Maybe we see the market sell off a little bit more, right? But basically anything from, now until the next 6 to 12 months, I think that we are seeing potential value in the market for long-term investors. All I'm hearing is just people talking about how you can't get into the market here. This is stupid for anybody to be even dollar cost averaging in or scaling into positions. And they say just wait for the market to bottom. Well, we don't know when the market's going to bottom. Nobody knows when the market is actually going to bottom. We can have all of these expectations of the market's going to retest the 200 weekly moving average. The market's going to retest this specific price level from years ago, whatever, right? We can have all of these expectations, but nobody knows. And that I have seen time after time the market expected to retest a certain level because from a technical perspective, it feels like a no-brainer that these levels are going to test. But the fact of the matter is, I've seen these levels come really close, but never actually testing and reversing, and then you lose out, right? If you're waiting and waiting and waiting for a certain price level to hit. Look, we don't know if we're going to have a slow, consolidating, range-bound market that tries to find a bottom. We don't know if we're going to get a strong V bottom off of some price level. We have no idea. And anybody that says you can't be looking at PE ratios, you can't be looking at all these things, none of this stuff matters, I disagree completely. We have to look at those fundamentals to try to find some type of zone or level or collective opinion on where we think the market is showing value or not showing value. That's how investing works. We are trying to take in all this data to try to decide if something is showing value or not showing value. And this is no different. We have to look at earnings. We have to look at, historical PE ratios like this. Okay. This is what we need to look at to have some type of baseline to tell where the market, if it finally hits a certain level, is of value or not. So I am getting a little heated. When the market is selling off and the bears come out and, all of this stuff is happening, you hear a lot of crazy stuff. And I just had to voice my opinion here. Okay. So do I think that the market is showing value compared to where we've been historically? I think that we're close. I think that anybody that's a long-term investor that wants to get invested, has cash on the sidelines, I think you need to perk up your ears a little bit and start paying attention to the next few weeks, and potentially making a plan of action. You don't want to be in a situation where you are paralyzed by fear and you don't make moves. Okay, you don't want that either. All right, I'll get off my high horse now. Okay, sorry, I just see so many things and hear so many things. It's so frustrating. Okay, so this is what I want you to do. One, I want you to take a deep breath. Yes, we are in a bear market. Is it the end of the world? No. In fact, I just want you to take a really hard look at this chart that's showing all of the indices performance over time. The market has ups and downs, but the down times are a lot less than the good times, right? The bad times are less than the good times. This is part of the process. Bear markets are part of the process. You cannot build wealth in a healthy way without bear markets. We need bear markets. Bear markets are the times where you can soak up as many assets as you can at better valuations. Would you rather us be back in the bull market with stocks valued through the roof? Two, you need to look at your strategy. What are you? Are you a trader who is more short-term focused, more chart technicals focused? Are you an investor who's more long-term focused? Do not try to manage a trade like an investment, and don't try to manage an investment like a trade. Okay, make sure you're very clear on your strategy. You are managing properly. And then three, figure out your time horizon. If you are retiring in 20, 30 years, does it really matter what the next year or two is? Does that even really matter what happens? You have to remember that the market historically over time has recovered from every single bear market. I'm going to say that again. The market historically over time has recovered from every single bear market. Now, past performance does not predict future performance. We all know that. We've all heard that. But based on what we know, that's what we can assume. So remember that this is not the end of the world. Humanity is going to continue to prevail and innovate and spend money. Consumers are going to consume. All of these things are going to continue to happen. And this is something we just have to get through. And it may be a bumpy ride on the way through, but we have to remember that there is a light at the end of this tunnel, and this is what market cycles are. This is the whole point. So hopefully you do those three things, take a deep breath, figure out your strategy, figure out your time horizon. If you're unsure what to do, be sure to check out our investor community. Myself and my co-host of the We Talk Money show, we're mentors in there. We do classes, we give insights. There's a chat. You can chat amongst us and other members. So we're talking shop all the time. Be sure to check that out if you are lost and confused and just need some education around how to properly approach environments like this. It's a great community to get involved in. And don't forget to check the description below for common stock. You can sign up, get a profile, follow me. I'm at She Talks Finance. Again, the link is in the description below. You guys got this. You can survive this bear market, I promise. I'll see you in the next video.